Americans are addicted to debt. Credit card balances just jumped above $1 trillion for the first time in US history. Now, you've probably heard many people in the past say that Americans are addicted to cheap debt, and that used to be true. But debt's not cheap anymore, with interest rates on credit cards above 20%. And yet Americans keep on piling on the debt. If you don't know who I am, my name is Joe Brown, and I run Heresy Financial University, where I teach active investors how to get higher returns while taking on less risk. We do this by learning how markets actually work. Link is in the description below if you're interested in becoming a member. Now, this is going to present some major problems, especially for anybody with student loans, especially due to the fact that over half of student loan borrowers are some of those people who are racking up the credit card debt. And starting in September of this year, interest on the student loans will start accruing again. And starting in October, student loan borrowers will be required to start making payments again. But wait, there's more. And apparently, some people are looking at the same exact data and coming to completely opposite conclusions. Apparently, somewhere deep in the data, credit card debt is actually shown to be falling, with the amount of debt from May to June dropping by $600 million for credit cards. Given that a drop in credit card balances typically precedes a recession, we need to look at the actual numbers to figure out, number one, what is actually going on here, because both can't be true at the same time. And most importantly, what does this mean for you? But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. They are straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. So first, let's take a look at the Q2 debt data that dropped. We see non-housing debt aggregated together from Q1 to Q2 increased from 4.66 trillion up to 4.71 trillion. Interestingly, housing debt dropped from 12.38 trillion down to 12.35 trillion. Diving into the non-housing debt data, splitting it apart by student loans, credit cards, auto loans, and other, we see that credit card debt did indeed rise from Q1 to Q2, from 0.99 trillion up to 1.03 trillion. This marks the first time in US history where credit card debt altogether exceeds $1 trillion. The data from Q1 through Q2 showed an increase in all other categories of non-housing debt as well. The impact for student loan borrowers cannot be overstated here. This, in my opinion, may turn out to be one of the biggest influences on the last quarter of this year, economically speaking, that most people, it seems like, are not taking into account. 40 million Americans are going to be required to start making their student loan payments again starting in October of 2023. People who have not had to make these payments for years now. On top of that, the cost of living today is way higher than it was last time they had to make these payments. And as is very obvious, the total amount of debt that all of these people have is much higher than it used to be. So in 2020, they had a payment removed, so their available income increased. Over the next 3 years, their cost of living went up, so all that extra income is now being used for other expenses. On top of that, they have more debt in other categories now, which means even more of their income is going to pay bills that they already have to pay. Now, on top of that, that original payment from student loans is being added back into the mix. This is going to be extremely economically painful for many American households. At best, it's going to cause a slowdown in spending for millions of Americans. And at worst, it's going to cause bankruptcy, defaults, and downstream effects like businesses not having that income anymore, maybe having to start layoffs. It is unknown at this point what the downstream effects of this will be. But even if we don't take into account the potential impacts from these student loan payments resuming starting in October, we can take a look at the impact right now that higher interest rates have had on the high amounts of debt. The New York Fed just released their quarterly report on household debt and credit, which shows charts like this that show the total debt balance and its composition across the United States. And this showing the mortgage originations by credit score, which shows a very small number of mortgages for the low credit quartiles, and almost all of the new mortgages over the past 3 or 4 years going to people with the really high credit scores. In sharp contrast though, auto loans we can see had a much higher percentage in the bottom quartiles, with borrowers with very low credit scores still being approved for a large percentage of the auto loans. But most concerning is the data on some of this debt becoming delinquent. This is a leading indicator of economically hard times. As people move into delinquency, that would forecast recession ahead. When broken apart by loan type, we see that auto loans and credit card loans very recently, within just the last year, have had a massive increase in transition into delinquency. And when focusing just on serious delinquency, again, auto loans and credit cards, though credit cards are showing a much larger increase. By the way, guys, I'm going to be speaking at the Stock Pulse Silver Symposium about the history and future of sound money. It's in Las Vegas from September 29th through October 1st. There's going to be a ton of other great speakers there. There are going to be plenty of opportunities for us to do meet and greet, hang out, get some drinks together. I'd love to meet you there. And everybody who shows up is going to get 1 ounce of silver as well, a 1 ounce silver coin. So I'd love to see you there. There's a discount link, 10% off in the description below. So sign up there, get that discount, and tickets are running out, so sign up soon. Now, to me, this makes a lot of sense because credit cards are variable interest rate debt, which means that a couple years ago, when I told people that very soon their credit card bills would be larger than their mortgages, it's very easy to see how that comes true. You lock in a mortgage a couple years ago, especially if you bought a house pre-2020, before prices exploded, you do a refinance to get your rate really low, your payments are tiny, but then suddenly your credit card balances explode to pay for your cost of living. And then starting in February of 2022, the interest rate on that credit card balance skyrockets above 20%. It's very easy to see how people are going to be delinquent and defaulting on their credit card balances first. Breaking down total debt balance by age, we can see that over the last 20 years, we have the largest relative growth in debt balance of people above ages 60, as the demographics of 60 through 69 and 70 plus back in 2003 were very small relative to the other age groups and are now much more similar. This reinforces the idea that the United States is facing a retirement crisis, which is what my last video was about. But even more than that, as we see that Americans of all ages are over indebted, this nation is facing a debt crisis, whether you're looking at the government, whether you're looking at corporations or individuals and households. There's no doubt about it that this country has too much debt. Now, as a shameless plug, that's why I run Heresy Financial University. This is a membership program where I teach active investors how to get higher returns with less risk. And part of that is first getting out of debt. So in my membership program, which gives you access to every single course that I create, my entire training library, one of those courses is the best and fastest approach to getting out of debt, to destroying your debt as quickly as possible. Link is in the description below if you're tired of being broke. Looking further, we can see that total delinquent consumer loans in the United States have reached almost 25 million. billion. Delinquencies of credit card and consumer finance loans are also at the highest level they've been since the financial crisis. Okay, so what about the data that I talked about at the very beginning of the video that seems to conflict all this, that says that Americans are deleveraging and actually getting out of debt now? Both from Zero Hedge and on Investopedia, I found information saying that credit card debt is actually falling as recently as August 7th of 2023, stating that US consumers paid off $600 million worth of credit card debt in June. Here's the chart that Investopedia shows. For any bar that is below the line, that is a month in which debt declines. And as we can see, June of 2023 is showing a $600 million decline. Like I said earlier, both of these things cannot be true at the exact same time. So we have to take a look at the actual numbers to see who is right, where are they getting this data from, and which one is true? Are Americans loading up more on debt or actually paying off their debt? This data right here from federalreserve.gov is the source. So let's take a look at these tables to see which numbers are correct. We are looking as of June of 2023, and here under revolving credit, we can see the number being referenced by Zero Hedge and Investopedia, a decline of 0.6 in billions, meaning that the Federal Reserve is showing a decline of $600 million. But wait, this is seasonally adjusted. If we scroll down to get the exact same data, consumer credit outstanding, but we're looking this time at not seasonally adjusted. We scroll down to find revolving debt, and starting in May, we have $1,215 billion. Going over to June, we have $1,225 billion. That is, in fact, an increase, not a decrease. Now, it is absolutely significant that the seasonally adjusted numbers are showing a decrease. We are seeing a slowdown in real debt accumulation, which makes sense because as interest rates continue to stay high and get higher, and as the total amount of money in circulation continues to decline, it is only a matter of time before Americans cannot continue spending the same amount of money they're spending. As more and more of their income gets diverted to servicing the debt, paying the interest on the debt, and then eventually being forced to deleverage, either through austerity or through default, we will see these debt numbers come down. Overall, this means less spending from consumers, which means less income for businesses, which means less spending from businesses, which means less income for the people those businesses spend money on, which is usually, unfortunately, employees. So this is a warning sign of tough economic times to come, and you definitely don't want to be in the boat of over-leveraged, of too much debt when this thing hits the fan. Time to prepare is now, so cash up, debt down, get ready because deals are coming. As always, thank you so much for watching. Have a great day.